Welcome back to Dividend Deep Dives, the channel where we talk about dividend-paying companies. And my goal here is not to talk like a banker or a fund manager or a Wall Street trader, but just like an everyday person deciding for themselves when is a good time to invest and not just rely on a tip from a stranger. So in today's video, we're going to be covering quite a few different stocks and quite a few different tickers, some of them based in the US and some of them based in Europe. And firstly, we're going to talk about Lowe's and Levi Strauss. These two are both based in the US, right? Lowe's is the home improvement company and everyone knows Levi jeans. Both of these companies have their ex-dividend date next week on July the 22nd. And that means in order to qualify for the next dividend payment, you need to own these on July the 21st, the day before the ex-dividend date. Both companies pay their dividends just 2 weeks later on August the 5th. They're both in the consumer discretionary sector. They both have a dividend payout ratio of about 40%, which means they pay 40% of their earnings back to investors as dividends and keep the remainder to reinvest in the company. And their dividend yield is about equal to around 2.5%. In my research, I found out that Lowe's was founded way back in 1921, so over 100 years ago. And it's had 20 years of increasing its dividend payments, so it seems fairly solid and stable. And looking at the chart for Lowe's, it's currently near the bottom of a range that it's been trading in for quite some time. So this may be an opportune moment to start dollar cost averaging into Lowe's if this is a company you're interested in investing in. Levi, on the other hand, was founded way back in 1853, so more than 200 years ago. It's headquartered in San Francisco in California and was listed on the stock exchange initially way back in 1970, but only for about 15 years. At that point in 1985, the founding company removed it from the stock exchange, made it a private company again, until 2019. So more recently, it's been relisted as a public company on the stock exchange. So those are two companies in the consumer discretionary sector, Levi's in clothing and Lowe's in home improvement. We have two more companies to talk about whose ex-dividend date is also next week. First of all, there's the computer company Dell, and secondly, Costco, massive membership-only retailer. If we look at Dell first, Dell has an ex-dividend date on the 21st of July next week, and it pays out dividends just over a week later on the 31st of July. Dell has a payout ratio of about 20%, so 20% of its earnings are paid as dividends to its shareholders. The remaining 80% gets reinvested into the company. And Dell has a current dividend yield of about 0.5%. And of course, Dell is in the IT sector. But having a quick look at the stock chart for Dell, it is currently way up there at all-time highs. The crazy thing, only 5 months ago, the stock price was at about $115. And right now, 5 months later, it's about $460. That's a crazy growth curve. Now, remember I said Dell's dividend yield is about 0.5%, 0.5%. Dell has only been paying dividends since 2022. So what's that, 4 years ago? And its dividend payment has doubled since then. So if you invested in Dell 4 years ago, your dividend payment would have doubled by now. That's not a bad return. The last USA-based company I want to talk about today is Costco, which has its ex-dividend date next week on July the 24th. And it pays out its dividends on August the 7th, a couple of weeks later. Costco's payout ratio is currently about 30%. So 30% of its earnings gets paid out as dividends and the remaining 70% gets reinvested. And Costco's dividend yield is currently 0.65%. Costco falls into the consumer staples sector of the S&P 500. And so when we're thinking of diversity, we've just looked at 4 companies in 3 different sectors, all based in the USA. If we're thinking of investing in the European stock market, there are two companies with ex-dividend dates next week. The one is IBT, International Biotechnology Trust. IBT is in the healthcare, or more specifically biotech sector of healthcare, which has seen an absolute crazy growth in the past year. IBT has a dividend yield of 2.8%, and its payout ratio is very unique, paying out a standard annual dividend of 4% of its share price. That makes its payout ratio about 15% at the moment. Now, IBT pays dividends only twice a year, and its share price is currently way over £1,000. Looking at the stock chart for IBT, this is very much near all-time highs. So if you're interested in investing in biotechnology, in IBT, perhaps wait for a slight pullback, and remember that if you want to, you can buy just a single share. Next, I want to move on to QinetiQ, ticker symbol QQ. QinetiQ is a British aerospace and defense technology company. QinetiQ is in the industrial sector, and it pays a dividend yield of 2.5% currently. Its next ex-dividend date is on the 23rd of July, and its payout date is about a month later on August the 20th. QinetiQ has a current payout ratio of about 45%, so almost half of their profits gets paid out to investors, and the rest gets reinvested. Looking at the stock chart, the stock price for QinetiQ is near the bottom of its most recent range, so this is potentially a good time to invest, should this sound like a good option for you. All right, so now I've spoken about 6 different companies, 4 based in the US, 2 based in Europe. And next I want to talk about covered call ETFs. Because remember, ETFs are baskets of companies. So instead of owning the individual companies like the ones we just spoke about, you can own a basket of companies all grouped together by buying a share of the basket instead of in each individual company. Now, there are many, many, many different ETFs out there. And the first 3 I want to talk about all have ex-dividend dates next week on July the 22nd. These are US-based ETFs, and they are ETFs that use a covered call strategy. Now, if you follow us at Mindship Theory, you will have heard about the wealth triangle, where we teach you how to make money 3 different ways using the same pot of money. And one of the ways we teach you is through selling covered calls. And this strategy, the covered call strategy, is exactly what these ETFs do. And because of this, they're able to pay a higher dividend than many other ETFs out there. And the 3 I'm talking about right now are SPYI, QQQI, and BTCI. SPYI tracks the S&P 500, QQQI tracks the NASDAQ, and BTCI tracks Bitcoin and crypto. And I've already mentioned, because these ETFs have a covered call strategy, they can pay a much higher dividend yield, which you can see here. SPYI's dividend yield is almost 12%, QQQI's is 14%, and BTCI has an absolutely insane dividend yield of about 26%. And what I've noticed is that many people who are teaching you about investing recommend only focusing on ETFs, right? Because then you own a little bit of the whole basket, which is true. But the thing to remember with ETFs, and especially covered call ETFs, is that because their dividend yield is higher, the risk of NAV erosion is great. And what this means is that the value of your shares or the share price can be eroded with time because the profits are getting paid out as dividends. And this is an important thing to remember when deciding to purchase any shares, especially those of covered call ETFs. It's important to understand where in the chart history we are making our first purchase. And if we look at the SPYI chart, it's currently near all-time highs. Now, could it go higher? Absolutely, but it could also go lower. We could always be at the very start of a bear market. So with any of these stocks, remember not to put in everything that you own. If you're going to make a purchase, only start with a very small amount. Something that you're comfortable to dollar cost average should the stock price go down. In other words, should the price go down, you're okay to purchase a little bit more at a lower price. making your average price lower than your original purchase price. If we take a look at the QQQI chart next, this is also approaching all-time highs, so just something to be aware of there. But if we look at the BTCI chart, it's almost the opposite. BTCI is very much near the all-time lows. But remember, this also doesn't mean put in everything that you have, because like with any other stock price, the stock price could go up and the stock price could go down. But if cryptocurrency is important or interesting or something that you think is worthwhile being invested in, then this might be a good time to start purchasing some BTCI. Now, these 3 covered call ETFs are USA based. If you're based in Europe, we need to look at UCITS compliant stocks and funds. And I found 2 covered call ETFs that are based in Europe and UCITS compliant. The first is JEPG. This is a JP Morgan Chase managed fund that pays an 8% dividend yield. And looking at the charts, it's also near all-time lows, so it could be a good place to start purchasing. We've just missed the ex-dividend date for JEPG, but it'll come around soon enough if you want to start investing in this right away. The second covered call ETF based in Europe is the UCITS compliant European equivalent to QYLD. This is an ETF that invests globally on the MSCI Worldwide Index and also uses a covered call strategy to pay higher dividends. Their dividend yield is about 12% currently, and the next ex-dividend date for the European equivalent of QYLD is on the 30th of July. Okay, wow, that was a lot. We covered 11 different possible investments that all pay dividends, some based in the US and some based in Europe. And my goal is to just keep talking about different dividend-paying stocks so that we all get more comfortable understanding things like dividend yield, payout ratio, stock charts, and everything else there is to know about dividend-paying stocks, so we can also all take advantage of the stock market and the vehicle that quite literally makes millionaires every single year. I hope this video has been helpful. Please leave me some feedback below, and I look forward to seeing you next time.